further. So, what is my situation here? My situation is that we have some possibility to deliver to Amazon. So, I still have to prepare this. But if you are checking the news, Amazon, Kuiper, Ariane 6. Blah blah blah. Ah, there is. Okay, happy people. But what is relevant for us? That we were able to collect 18 Ariane 6 launches from Amazon money. Which is nice because they are spending their US dollars at our company, which is good because in this case we can earn US dollars, which creates US dollar exposure for me. So, when do I have to launch this? There was no deadline. Whatever. So in this case I can do the scheduling by myself. Obviously I don't want to do the launch to happen here because this is the low profitability regime at the company, so we should push it here when we can earn a lot of nice money from Amazon with way higher effective margins than before. So easiest way if I'm just adding 2 lines here. So let's say US dollar revenues. And it will be green because this is revenue. Okay, for the same years, we know that we have 18 launches. So I'm saving the URL here, or maybe just adding a link here and then. Oh no, yeah, there is. Yeah. So we have 18 launches, and then we can say that, okay, let's have 9 launch here, 9 launch there. What can possibly go wrong? Obviously, the first thing which comes in my mind that it will be really hard to collect any kind of exchange rate data for that one. But, okay, this will be just one problem from the many. Then, what is the pricing in US dollar? So, are we selling them just after the current exchange rate, because right now we can say that this is the current unit price in euros. So what is happening with the unit price in US dollars? So what is the current exchange rate? Stoku.com, Euro USD. Right now is, yeah, this. So to convert our euros to US dollars, then we have to multiply this number with that number, and then we have US dollars. But come on, we are talking about Amazon. And mostly they had to do this diversification because Shareholders were suing them on court that they have to diversify. So originally the great idea was that only Jeff Bezos' space company can launch this satellite constellation into orbit. But after that, since Amazon is a publicly traded company, then shareholders were unhappy, so they were forcing them to open up this market to diversify. So that's why even the arch enemy SpaceX got some launches from Amazon, which is absolutely funny. So in this case, we can say that, okay, let's milk Amazon a bit more. Let's collect some extra profit, because they have to do it, doesn't matter what happens. So I added a nice 10% margin on this thing because we like them so much. They're nice people. They treat all their employees completely well. So, yeah. Okay, so this is the unit price in US dollars. And after that, we can say that if we are realizing additional, yeah, obviously I have to reduce the number of sold products in euros because now we have this. Some of our launches are booked by Amazon, so at least in this case we know that who will be our business partner. But in case of revenues, we have to give this thing back. Just we should not remember, or we should not forget, that we have already a US dollar euro exchange rate here. So did we use pink color for it? No, not yet. Okay, so this is pink. And now we just have to correct our revenues that, okay, plus 9 multiplied by this number, multiplied by, sorry, divided by the US dollar exchange rate. Because here he multiplied it, so backwards it should be divided. And again, plus 9 times the discounted price divided by the exchange rate. Are we richer than before? Oh yes. We can see delicious 200 million euros flowing towards us. Okay. Then, once we did this, then obviously we have this US dollar exposure. So right now, under this setup, exchange rate risk was not present there because it was easier to set up it as that we are at parity. But now our job is to determine that what can be the exchange rate for the next 5 years ahead? Simple question, obviously. So, what are the options here? So we can go to different databases, so we can check futures, markets, as yesterday I tried to show you. Okay, we are always defining everything sideways, so maybe this will be that data source. And this will be the year, so 1 year, 2 years, 3 years, 4 years, 5 years ahead. Then poll, expert polls. Then we can have historical trend line. We can have Gauss simulation. And also we can have a friendly war vector autoregressive forecast. And once we can see what is happening there, then we can start to evaluate everything. So, yeah. let's dig into the databases because we have many fancy of them, and yesterday I spent so many time to find them, and now I have to find them again, which is cool. So FX rate, home, majors, euro, spot rate, we have there are the CMA Euro US dollar futures, and this is the key problem here because this is not much. If I'm clicking on it, still we can see that this is not short because of not enough space, graphical space, but because this is all the data what we can have here. So we can look forward until next year's March. Come on, that's not much. So for this December, we can see that the market is right now expecting 1.159. 59, and come on, it's only March. Peak of financial market 1.165. Great. So this is the best what we can have here. So this is CMA Euro futures. Okay, ennek kellett copy even. From Chicago Merchandise Exchange. Also, we can have polls. Luckily, we are in November, so we can see that, okay, let's pick up this 1 month median. So 1.16, 1.17 is the 1 year ahead, by 1 month ahead, and then 1.21 is for the next year, and after that we cannot see anything for the third year and so on. So this is all the wisdom which can come from the capital market, unfortunately. So let's see European central banks, because come on, they are central banks. So great forecast. Macroeconomic projections. So what kind of projections do we have? Inflation and GDP. And let's check the full report because we need exchange rates. So yeah, inflation. US dollar euro, so we have to turn it backwards. At least we can see that they have to present some kind of a expectation. But again, this is euro per US dollar exchange rate, so we have to change everything here as well. Oh no, I was using the same denomination. Okay, just that's good. So at least we have some forecasts. So here we can see that end of the year we have 1.13. I'm adding the link here as well. So 1.13. Then for next year 1.16. 1.16. Okay, so at least we have some forecast for 3 years ahead, which is something. Oh, they have also interest rate. Okay, I never use this one. Okay. Not today. Because after that, this forecast data is not existing anymore, so we don't have to care about it. So let's see. And for this reason, I collected, or I utilized one of my big data sets what I used for macro modeling purposes during this autumn. So you can see that there are many different data. One is Euro US dollar. What is the denomination here? Okay, this is the whole year here, but yeah, this is in US dollars, which is good. And then we have all the other stuff like sovereign premium compared to the US, so differences between interest rates. Also, I checked also what is happening if we are compensating with inflation differences, so real sovereign premium was added, exchange rate stability, foreign exchange reserves at the ECB. So there are many things. First of all, I have one simple question that if I'm just... Did I uploaded it into CoSpace yet? No, not, because I started to talk. Yeah. So first I have to upload it, because in this case you can see it, bless you. And then I can continue my talk. So we can copy and paste it here, and also copy and paste the date. Obviously, Excel is not... Oh, they are sophisticated enough. Come on, guys. This is the first time during this semester that I'm scrolling down a date and it realizes that it should grow in the proper direction. Rare phenomenon. So, and if I'm continuing it, are you allowing me to do so? Oh, thank you very much. Now we can say that, okay, let's create a forecast with Excel, because I just have to highlight these two things, hopefully. Then data, then forecast sheet, yes. And I just have to hit execute, and then I have something like this. So with all these calculations, Excel showed me that the exchange rate will not change at all. So this is the median line, these are the confidence intervals, and these confidence intervals, until both sides are positive or both sides are negative, then they are significant, so it's really easy to achieve significance here. But yeah, so it says that exchange rate will not change at all because of reasons, unknown reasons. Okay, we can say that, yeah, this practically the exchange rate follows completely a horizontal trend line, so it will fluctuate around this current level. So that's not nuclear physics to realize that something like this will happen. Just it's always funny when we can see that, yeah, that was all the... So Excel this problem, and now we have oh, I copied in the wrong place, sorry. But this is completely a constant number, so I will just pick up 1.50 or 1.60 and then it's 16. And after that it says that, yeah, this is what we have here. Okay, this is not Hungarian forint, which is depreciating always, so okay, there is no trend within. Then, next thing, let's create simulation, but let's not create simulation at first because it's easier to have a macro model at first. So, we are utilizing our knowledge from international finance when we were saying that, okay, for any macro modeling, we need the exchange rate and also we need the sovereign premium. Yes? Yeah, okay. So, because we learned that uncovered interest rate parity is the difference between the long-term interest rates in one currency and the long-term interest rates in the other currency. So in this case, both are 1 year government bond yields. So risk-free rates, their difference, and also I was taking the difference also between the inflations. So maybe the real sovereign premium or the sovereign premium, some of them or one of them will be useful for this purpose. So what can possibly go wrong? Let's save it. And then there is... should we do it in Gretel? Let's do it first in eViews, and after that I will show you in Gretel as well, because eViews is also free for students, so you can download the eViews Lite if you want to work with sophisticated econometric model, like in Tamás Rácz course, but also eViews is quite an industrial standard. So eViews and Stata, both of them are the most used softwares if you need any kind of an analysis. So that's why I'm showing this one. I don't want to show Stata because that one is much more like a scripted language. Not dated panel, dated regular frequency. Yeah, this is mostly data, and this starts in 2000. And okay, it was here was the date, but it was not realizing it. So sometimes eViews is not that smart. And then we have the model, or sorry, the data set. Now we have to build up the model. The model is absolutely simple. So we are saying that I'm also copying it. Real sovereign premium, that one here, just for scientific purposes, and then we can see that oh, we cannot see, so this is way too long, and this is not a problem. The problem is that I have to extend also the timeline. I mean this date here. What is the end year what we require to analyze here? Statement 18. Okay, so this one is not necessary, just the end of this year. Okay, so for any econometric software, doesn't matter, Gretel, eViews, whatever, we have to define always the dates, and we have to define always our assumption about recession. So this recession data is coming from the business cycle clock of the European Commission. So in this case, we have the Eurozone, we have the all time periods, and in this case we are just picking up the time periods. So which quarter of years was the Eurozone in recession? Obviously around the great financial crisis, around the sovereign crisis, and also we have COVID here. So this dummy variable represents this setup. And also we can see that not just recession, so this gray, dark gray parts, but also these light gray parts are represented here because this is poor growth. So in this case, if we are setting up this variable, so let's be absolutely pessimistic about this one. So let's say that, okay, this poor growth will remain. What can happen with the exchange rate? Yes. So I have to load in. No, not to save. So import from file, from our folder, which is here. Open input. Now it says the date series date. In the previous version it did not realize that what is a date, but now it realizes, so cute. Okay, and now we have to calibrate our sophisticated model here. So obviously I would like to just check real sovereign premium and its impact on the euro-US dollar exchange rate. And also we would like to utilize the recession dummy. Hopefully there is no IMF loan, hopefully there is no change in the exchange rate. So yeah. Sorry, this one is for outliers. So, okay, we don't care about outliers. Yeah, so this is the these endogenous variables are these variables, and then this is the exogenous shock. And also we have to think about that how many months we would like to include. So lag number for past data. So the rule of thumb is always that we should cover at least a year in any macro analysis. So it's 1 to 12 months if it's a monthly data. Then it's 1 to 4 if it's quarterly, and obviously it's 1 to 1 if it's annual, or 1 to 2, it depends. Sometimes software doesn't like 1 to 1. So in this case we have to select 1 to 12. And yeah, and also this is a VAR model, so we have to say that we have to differentiate the data set because the mean should be 0, or at least it should not change in time. And if we are just keeping level data without differentiating, then it will grow somewhere. If we are taking the difference from one month to another, then it will start to fluctuate around 0. So this is a highly technical issue which must be addressed because yeah, so sorry, going quick menu, then var specification, then we can see the endogenous variables, exogenous variables. We have to set up the lag. And the last thing, that we have an estimation sample, which is ridiculous because the dataset ends in 2014. So this is the. But we have. So if you would like to build a forecasting model, then there is always a training data set. And there will be a test. In the past, people were always saying that, oh, 80% should be the training and the remaining 20% should be the testing. But nowadays, since we have a crisis in each year, different kind of crisis, so now the dataset is so crazy and erratic that practically it's easier if we are just saying that, okay, let's cover 1 year for testing and the remaining should be go for training, and hopefully in this case all recent information will be there. And the other thing that we should not use the whole data set. So for a regression to be reliable, at least you need 30 to 40 data points. And if we are under it, then we have really serious error messages or things will not work. We are not able to overcome autocorrelation and so on, so many anomalies can appear. But the second problem is, so we have mostly data sets, so this is not a big deal because we have hundreds of data points. But still the training data set, so where we are calibrating the model, it should contain recent stuff. I don't care about what is happening in the 2000s. It was far away, monetary policy behaves completely in a different way, the exchange rate behaves completely in a different way. So let's say that we should start at least the calibration in 2014, because this is when ECB started its unconventional monetary policy. And since we would like to incorporate everything from the recent years, then we should also stop in 2023. So this is quite an aggressive approach. But also we could say that practically we could include everything only from the start of the COVID, because in this case we have 2020, 21, 22, 23, so 4 times 12, it's already 24 months. This is absolutely enough for any regression modeling, so we can be even more aggressive. So just focusing on this really small part of the data set, and then the testing part will go for 23 to 24, and then forecast is we have to start so we have to include the testing part, because in this case on empirical data we can check the accuracy of the whole stuff, and after that we can say that, yeah, but it will end in 2028. So first we add this in, let's check it, that sovereign premium, no missing data, good. Then now we cannot use the inflation correction, whatever, at least we have something. Then that's why it was so strange that it was not allowing any aggressive assumption or solution for the estimation sample. And now we can see that, okay, it's 120 observations, so now it's proper. Then we can go for aggressiveness. So let's say that we are only starting with the COVID and we are only including the crazy periods. Still 48, so now it's appropriate. And then let's see residual tests. So in any regression, when we are estimating something, the first thing is that if in the residual there is any information remaining, it means that all our coefficients are biased. So that's why we should not have autocorrelation in the data. Because otherwise we can be really happy that, oh, we have beautiful results, just they are meaningless or they are misleading completely. So in this case, this guy and that one should be bigger than 0.05, then they should be green, and if they are, then we have no problem. Are we happy? Yes, we are happy. But this is only for historical analysis. So when people in central banks are trying to forecast, for them it's much more important to have normal distribution in the residuals, and this should be bigger also than 0.05. So if this would be our day job, then we would be not so happy. But right now we are just learning how to do things, so we don't have to compensate, but this should be bigger than 0.05 because this is not normally distributed. The first variable, which is sovereign premium, is not normally distributed. Why? Because it has a lot of extreme fluctuations, so kurtosis was failing. So we should include additional dummy variables to represent nasty things there. But yeah, right now we don't have the time because I messed up with the missing data. So okay, so that one is not that fine. Then let's see that is this working anyhow. So impulse response functions to see how shocks are spreading through the whole system. So how sovereign premium shocks are affecting the US dollar euro exchange rate. Please use lines. Please cover 2 years. Use other confidence intervals, and we can see that these are not affecting much, because to be significant, again, if you are seeing any error bars or in this case confidence intervals in any kind of a regression like model, both sides of the error bar or the confidence interval should have the same sign. So if the under or the lower bar is negative and the upper bar is positive, then this result is not significant. It doesn't matter, it's VAR model, it's VACM, anything. So until we can see error bars or conf intervals, generally in statistics, they should have, everybody should be positive or everybody should be negative to have significant results. So this one is not good. Can I go for structural factorization, or that one is maybe to check for long run responses? No. Structural decomposition, yes. Accumulate response. Meh. We can see that, okay, in the long run, at least with weak confidence interval, which is usually used by central banks, we can see that if interest rate premium increases, then the currency starts to appreciate. So, okay, at least this one is working. So, yeah. So, the next question is how the currency responds on shocks coming from the interest premium. So somewhat appreciates on the long run, so we can see that the confidence interval, which is the weakest because it's only one standard error far away from the median line, then now this is significant, or this is positive after 1 year. So both sides, so this one is significant, so we can see that, yeah, this means that, okay, the currency start to appreciate once they have some sovereign premium. So, okay, at least we were able to verify a bit what we learned from international finance. Then, what is the weight of this rule? So of the sovereign premium. Exchange rate movements. So in this case we can see, okay, first I have to change the decimal points to decimal commas. And then I have to rename the shock 1 and shock 2 because we know that they are representing these two guys. And also we know that this beauty is only significant after 14 months. Here is also significant here and there, but okay, after that this has a tendency to become significant. So let's use green color here, so we can see that this will describe at least 1/3 of the changes of the exchange rate. So 37%. So 36% of the USD movements are described by the sovereign premium. It's not much, but if we are comparing it to emerging currencies, this is way better than what we can see in many cases. Sometimes this is absolutely zero. So, talking about forint. Okay, so these are the interpretations, and then if we are doing the forecast, then, because this is why we came here, so until then we were just checking that is this reliable at all, and then we have to say SOF. Let's have some uncertainty coefficients. Forecast sample starts at the beginning of 2023. Is this? Oh, this is not good. Yeah, because I already used up this data, so it should start in 2024 because it's end here. It ends here, so yeah. It's missing. Then, okay, please don't freeze. Thank you. And now we can see it. So this is a beautiful, homemade, and significant forecast. What can happen with the euro-US dollar exchange rate in the near future? And this is sad. So, based on the current information in the data, harvested during the 2020s, we can see that there will be a depreciation for the US dollar again and again for the next 2 years ahead, which is sad. Can we say anything about the accuracy of the model? Unfortunately, until we have only one model, then we cannot, because we have to select the root mean square error and the mean absolute error, but we can only compare alternates. So we have to check the root mean square error is that what is the scatteredness, so what is the volatility of the accuracy of the forecast, and the mean absolute error is that how accurately can we find the expected value based on the empirical data. And if we have an alternate model, then we have to find the lowest model MRSA and May, but right now we have only one model, so we have to be happy with this one, and that's all. So yeah, let's copy it and let's bring it home. Obviously, if this would be our day job, then we can, our job would be that we have to fine-tune it and work on it more. But right now it's okay, good enough. And also we have the forecast data here. Yes, so I can just copy it and then paste it into our data set. It starts here. So we can see that actually there was not much deviation. Okay, here there was already some, but after that, what is happening with the data set, then it starts to account for more and more depreciation. So how can I acquire this easily? So this is for the end of the year. So 26. Usually these war forecasts are not that pessimistic, but right now I was able to create a scenario when they are. And also I'm doing it in the wrong direction because our 0 year is, yeah, this one. Okay, so yeah. So now we can see that we have nearly a consensus for all the possibilities. And we have 5 minutes, so I don't want to continue with gauge forecasting because that would be a completely different bag of potatoes. So we will continue from that one during next class. So that's all for today. And at the end of the day, once we did this, then after that we will go through the list what we defined yesterday. So we just have to consider this workflow to see that what currencies. Okay, we know that which currencies because it's US dollar. Then what is our next position? Then obviously it's about we have more revenues than expenditures. It's a common error that many groups are forgetting that they are using Falcon 9 engines. Then obviously you have to buy it from the US because this is manufactured by SpaceX, so you have to pay with US dollars for it. So for you, there will be expenditures in US dollars. I only have revenues. So that's the difference between the two strategies. So what I need is the depreciation of the euro. And this is not happening because we can see that this is going completely in the other direction. Is the exposure relevant? we can see, we will see. So this is why we have the different data to test it. Foreign exchange regime floating and relevant. Yeah, so we have to use derivative because this is floating and I think it will be relevant. And then is also historical data, forecast, and so on. It also appreciates, right now we can say that this is completely contradictory, so this is not the case, so we have to do a hedge. Total hedge at the end of the day. So this is in no case, this is one I have to select once I was able to realize that the relevance is there. So this is the homework for next week. And also this is as well. So yeah, that's all.